Stanley Black & Decker, stock ticker SWK, currently trading at $77.67 per share. This is a company that's been hammered over the past year for a few different reasons. They're currently coming out of a disastrous quarter, and the company has reported a large decline in volume, management slashed earnings guidance, and revenue estimates. And when you combine all those factors with the negative economic performance we're currently seeing, we have a stock that is down over 58% over the past year, and year to date we can see they're down 58.23%. So in this video, we're going to be jumping into my stock valuation spreadsheet to see if we can find the intrinsic value of this company. Now on this spreadsheet, we're going to look at 4 different valuation models. We're going to look at Graham's valuation, a discounted cash flow model, a multiples valuation, and finally a dividend discount model. And all 4 of these valuations will roll into our output tab. But let's go ahead and jump over to our stock screener. If you'd like to be able to download the spreadsheet, then you can head over to my Patreon page at the link in the description. But let's go ahead and come up here and we will plug in the stock ticker SWK and hit enter. And you can see all of this data is going to automatically load in. Now the good news is if we come over here and look at the dividend data, we can see they're paying out $3.20 per share, which is a huge decline in share price, gives them a dividend yield of over 4% now. So a really nice starting dividend yield, especially for a dividend aristocrat. Payout ratio currently sitting at about 51%. Come down here, we can see analysts currently have a target price of $114 per share. I was kind of surprised to see it sitting that high. Very high institutional ownership and a beta of 1.28, so you will see a little bit more volatility in the stock than normal. But let's go ahead and jump into our first valuation. That is going to be Graham's valuation. I'll go ahead and zoom in here. And this is a valuation model invented by Benjamin Graham in order to calculate intrinsic value. And here's the formula he laid out for us right here. So you can see the first thing we're going to need is our earnings per share, which we have listed right here. We then multiply that by 7, which is the price to earnings of a company with no growth. And then we apply our growth rate projection. And I've seen all types of growth rate projections for this company moving forward. There's a lot of people bearish on this company, a lot of people bullish who think it's trading at a good value. So I'm kind of going in the middle with a growth rate projection of about 6.5 here. We then multiply that by 4.4, which is the average yield of AAA corporate bonds. And then we divide by Y, which is the current yield on AAA corporate bonds. And at the time of this video, it's as high as it's been all year, which will lead to a lower valuation. And we can see when we plug all this in, we come to an intrinsic value of about $78 per share, which is actually right at the current trading price for this company. But let's go ahead and move forward and look at our discounted cash flow analysis. And in order to perform a discounted cash flow analysis, we need to project a growth rate to the future free cash flows of the company. So again, I plugged in the historical free cash flow year over year for the company. This allows us to see our year over year growth rate. It's kind of been all over the place lately. We can see overall average growth rate of about 19.8%. It definitely won't be that high moving forward. And again, there's growth rate estimates that are showing really low, really high. So again, I'm going with the average estimates of about 8%. So I apply that 8% to the future free cash flows of the company and the terminal value, which is the sum of all the future free cash flows past the year 2030. I then took the present value of those future free cash flows and added them together here, added the company's cash and cash equivalents and subtracted out their debt to find their equity value. Once I had the equity value, I divided by the number of shares outstanding to come to a discounted cash flow price per share of about $101 per share. So that's trading at a pretty good value according to our discounted cash flow model. But let's go ahead and move forward. We'll look at our multiples valuation. The idea behind this valuation model is we should be able to value a company using a multiple like the price to earnings multiple. And we're going to see how the market is valuing companies that are similar in structure to SWK. So you can see the comparable companies we're using right here. We're taking their stock price and dividing by the earnings per share to get their price to earnings multiple. We then take the average price to earnings multiple for this company and multiply by SWK's earnings per share to come to an intrinsic value of $98.97. Now, what does this mean? Well, if we look at the average price to earnings multiple for these companies at about 17.5, jump back over to our stock screener and scroll down, we can see the price to earnings for SWK is currently sitting at 12.7, a little bit of an indicator that it may be undervalued when you compare it to their peers. But let's go ahead and look at our last valuation, and that's going to be the dividend discount model. And I'm a value dividend investor, so this is a valuation model I love to look at because it values a company based on how much they pay out in dividends and how much that dividend is increasing over time. If we jump back over to our stock screener, we will remember they're currently paying out they have a dividend yield of about 4%, so that's a pretty good starting dividend yield. Let's go ahead and look at the dividend growth, and you can see I plugged in the quarterly dividend payouts right here, so we can see how much they pay out each year, and this allows us to see our year over year growth rates. They have a growth rate of 4.5, 1.4, 12.86, 1.27. So kind of like the free cash flow, it's kind of been all over the place. 4.5 isn't too bad. I'd like to see a little bit higher than 1.45, but a year of 12.86% growth is really solid. But the most recent dividend increase just sitting at 1.27. not very good at all. But overall, that's an average year-over-year growth rate of about 5%. Moving forward, I'm projecting a growth rate of about 3%. After projecting a discount rate of 8.5%, we come to a dividend discount model price per share of just right at $60 per share. So that is quite a bit lower than the current trading price. But let's go ahead and jump over to our output tab. And here on the output tab, we're going to see all 4 of our valuation models: Graham's at 78, multiples at 99, discounted cash flow at 101, and our dividend discount model at 59.93. When we average all 4 of these together, we come to an intrinsic value of $84.64. Now, the current trading price for this company is $77.67, but as a value dividend investor, we do always want to apply a margin of safety. So let's say in this scenario, we want to apply a 10% margin of safety. Based upon that, our acceptable buy price would be $76.18, meaning it's not currently a stock we should be buying. Let's say we are more conservative with our investments and we apply a 30% margin of safety. Based upon that, our acceptable buy price for this company is $59.25 a share, meaning this is still not a stock we should be buying. Now, this is a great example of a company where just because their stock price declines by a very large amount does not necessarily mean it may be trading at a good value. We can see over the past year, again, almost a decrease of 60% in their share price. So a lot of people probably started buying in right here when they saw this large dip, thinking that it was trading at a discount. But when you look at these valuations, you can see that's just not the case. A lot of the times these companies will go down because it will reflect their intrinsic value by going down. But as for me, I will keep them on my watch list. I think there's probably better opportunities out there. Obviously, this is kind of a middle of the road projection. Some analysts are projecting higher growth rates and some are projecting low. But for me, I'm probably going to stay away from this stock. But go ahead and let me know what you think of this company in the comments down below. If you'd like to be able to download the spreadsheet, you can head over to my Patreon page at the link in the description. So that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.